Okay, so let's start with Module 4, Business Organization and Taxes. So our learning objective is to, first, after the completion of the module, student will be able to discuss the progressive nature of corporate income tax, differentiate various forms of business organization, explain the nature of modified accelerated depreciation and derivation of deferred tax, and the computation of dividends. Our topics is more on implication of taxes to the firm, deferred taxes, and dividends paid to the firms and shareholders. So, let us discuss first what is business organization. According to S. Nicholas Woodward of Britannica, a business organization is an entity formed for the purpose of carrying on commercial enterprise. So this organization is predicated on systems of law, governing contract and exchange property rights, and incorporation. There are three forms of business organization. So you already know that. So it is divided into sole proprietorship, partnership, and a corporation. So what are the taxes? Taxes are a compulsory contribution to state revenue or to the Philippine government, levied by the government on workers' income and business profits, or added to the cost of some goods, services, and transactions. So it's according to dictionary. So here in the Philippines, income of resident is based progressively up to 32%. So we have withholding tax table for that. Resident citizens are all taxed on all their net income derived from sources within and without the Philippines. So meaning to say, without the Philippines is business abroad. So you are going to compute also the tax for that. The non-resident citizen, whether individual or not, is taxable only on income derived from sources within the Philippines or here only in the Philippines. A corporate taxes have an income tax of 30% and minimum corporate income tax of 2% if there is a loss income. Taxes in the Philippines are divided into income tax and business tax. Implication of taxes to the firm. So, there is a positive and negative implication of taxes individually and on business perspective. So, for the employees, withholding tax decreases, so the implication is net pay increases, wherein there is no categorization. Now, if you are a single, a head of the family, or married individual, as long as you are a citizen of the Philippines. So, basis of computation is 0 to 32% based on the withholding tax table. Next is for the sole proprietorship. So, once business established, a tax from her business or his business will be computed based on using withholding tax table. If a business earns 250,000 or low, then tax will be waived to 0%. It is not applicable to pay tax to BIR, but still, you need to submit a documentation for BIR. Example, the form 16010, so you need to submit it to BIR, or 17021 or 1702Q, so you need to submit it to BIR. Next is for the partnership. Partners' business are not taxed, so instead, they are taxed based on their individual earnings. BIR giving them chance either to choose 8% professional tax or using withholding tax table. Next is for the professionals like doctor, accountant, engineering, etc., professional basketball player, etc. The taxes tremendously decrease to 8% as long as income are not exceeding to 3 million. So, if the income increased to 3 million, then the basis will not be the BIR withholding tax table. For the corporation, wherein the owners are stockholders of the company, payment of taxes are 30% based on the gross income less all costs and expenses. So remaining income after deducting tax will be the basis to get a portion of it to be divided among stockholders. So that portion are called dividends. Next is we have the value-added tax. So for the value-added tax, basis and its percentage are the same with the old law. Next is for the estate and donors tax. There's a tremendous decrease of paying tax since it's only 6% to be paid insured to BIR. So whatever it is before you give it or you donate it to something or for the estate, you need to pay 6% tax to the BIR. Next is for the businesses like liquor and cigarette. So there's a tremendous increase of tax since government believe that this business is not a necessity for the society. It is also called as sin tax. Next is other businesses that are not necessity for the consumption of public or community, such as juices, cosmetic surgery, etc., increases its tax percentage. Also, the oil, the gas and oil, increases its tax. So, you need to see BIR website for that, for the percentage. Next is we have the non-resident citizen in the Philippines are not subject to tax. The non-resident alien who are only here for leisure are not subject also for tax. The resident alien with business in the Philippines are applicable to deduct taxes. So, see BIR website for the percentage. So, deferred tax. So, deferred tax is a notional asset or the deferred asset or deferred liability to reflect corporate income taxation on a basis that is the same or more similar to recognition of profit than the taxation treatment. So, it's under Wikipedia. According to Investopedia, deferred tax liability is a tax that is assessed or is due for the current period but not has been paid. The deferred comes from the difference in timing between when the tax is accrued or when the tax is accrued and or when the tax is paid. A deferred tax liability records the fact that a company will in the future pay more income tax because of a transaction that took place during that current period, such as an installment sales receivable. So this deferred tax liability is also called as accrued income tax. In layman's term, a deferred tax liability means the amount of tax that is underpaid, which will eventually be made up in the future. The tax obligation is paid on a different date. That is why it is recorded as deferred tax liability or accrued tax liability or accrued tax. Deferred asset or deferred taxes under asset. Items on the company's balance sheet that may be used to reduce taxable income in the future are called deferred tax asset. The situation happened when a business overpaid taxes or paid taxes in advance on its balance sheet. So these taxes are eventually returned to the business in the form of tax relief. So it is also known as the prepaid tax or the prepaid income tax. So it is part of current asset. Overpayment is considered as asset of the company. In layman terms, a deferred tax asset means the amount of tax that is overpaid. It happens when at the end of the year, the company's business incurs losses. The already paid taxes can be recorded as part of the deferred asset. Okay, so now we are dealing with the MACRS or Modified Accelerated Cost Recovery System in the United States. So under this system, the capitalized cash, the basis of tangible property, is recovered over a specified life by the annual deduction for depreciation. The lives are specified broadly in the Internal Revenue Code. So it's according to Wikipedia. So, in the business, MACRS or accelerated depreciation are used to minimize the payment of tax on the first 5 to 7 years of operation through using double declining balance method or the 200% method of depreciation. Then using the straight line of depreciation on the remaining life of the non-current asset. You need to see my YouTube video on that. So it's I discuss all the depreciation expense method and how to compute this one. Okay, so next is the dividends paid to the firms and shareholders. So according to Wikipedia, a dividend is a distribution of profit by a corporation to its shareholder. So when a company or a corporation earns a profit or surplus, it is able to pay a proportion of the profit as a dividend to shareholders. So any amount not distributed is taken to be reinvested in the business. It is called retained earnings. Last is, according to James Chen of Investopedia, which is updated on July 8, 2020, a dividend is a distribution of some of the company's earnings to a class of its shareholder as determined by the company's board of directors. Common shareholders of dividend-paying companies are typically eligible as long as they own the stock before the dividend date. So dividends may be paid out of cash or in the form of additional stock. So this topic is more on business organization and its taxes. Okay guys, bye-bye.